For this tutorial, you need to access the question on Matilda, which is a past paper question. So we're going to have a look at this. Matilda has been operating as a sole trader for 2 years, trading as Peachy Crafts, selling handmade gifts from her shop in Ballycastle. The following is a trial balance for the financial year ended 31st of December 2012. So it gives you the trial balance, and then it gives you notes at the bottom and the task. So this is a full account, which is going to ask you to do both the income statement and the statement of financial position. And we're also going to have some theory here. The first thing that you do whenever you open a question like this is you go down through the trial balance and identify where each item appears. Each item in the trial balance will either appear in the income statement or the statement of financial position, while all your notes will appear in both accounts. So we're going to go through them now. Sales revenue, that goes into the income statement. Purchases, income statement. Wages, income statement. Rent, income statement. Insurance, income statement. Electricity, income statement. Advertising, income statement. Telephone, income statement. Administration expenses, income statement. Equipment goes into the statement of financial position, S. Trade receivables, statement of financial position, along with trade payables. Bank goes into the statement of financial position, along with capital and drawings. Inventory at the start of the year is your opening inventory, so that goes into your income statement. Now let's have a look at the notes. The first note, inventory was valued at £450. That's your closing inventory, so that goes into both the income statement and the statement of financial position. Advertising prepaid amounted to £250, goes into both accounts, and then you go up to your advertising. Remember, prepayments are taken away, so I would make a note for yourself beside advertising minus your prepayment of £250, so you don't forget about it. Equipment should be depreciated at 25% using the straight line method, and I will talk about that in a moment. Administration expenses amounted to £55, so that goes into the income statement and the statement of financial position. So does the depreciation. Administration expenses owing £55, you go up to your administration expenses, and remember that you have to add on £55. Anything that's still owing, you add it on. Telephone owing goes into both accounts, and you go up to your telephone bill and you have to add on £95. Anything that's owing, you add it on. Electricity owing £83, so go up to your electricity plus £83 so that you don't forget about it. Allowance for trade receivables, 20% of trade receivables to be made, that goes into both accounts. So far I've gone through very quickly the trial balance and identified which account each item goes into and gone through my notes. Before you start your question, there are 2 notes that you need to do a workings out, and that is your allowance for trade receivables and your depreciation. Okay, so we're going to look at both of those now. So this will be a calculation that you will do out for yourself. Calculate the amount for depreciation. It tells you in the question paper that the equipment is going to be depreciated by 25% using the straight line method. Okay, so straight line method comes of cost. So the cost of the equipment, which is in your trial balance, if you look at your equipment, where is it? Equipment, the cost is £6,800. You multiply that by 25% and that gives you 1,700, and that is the depreciation for this year. Okay, now we're going to look at our trade receivables. The trade receivables is £700, and they've told you to create an allowance of trade receivables of 20%. That is prudence. What that is, the business is saying is that they are owed £700 by their customers, but some will not pay. So they are going to create a provision of 20% for that. So how you work out what it is, trade receivables, customers who have bought goods but not yet paid, 20%. The trade receivables amount total is £700. Multiply that by your 20%, and so it works out at £140. That is the trade receivables, the allowance that we are putting in for this year. Make sure that you use a simple calculator, and in your calculator put in 700 multiplied by 20%, not 20, 20%, and that gives you £140, which is this year's. So, once you have gone through your question, calculated your depreciation and your trade receivables, you're now ready to complete your question. Now, whenever you put each item in, I suggest that you tick it off as you go along. So we're going to complete our first account, which is our income statement. Okay, so the first thing that goes into our income statement is our sales, and our sales is £29,050, and I would go back to the question and tick that off that I have used it. There were no returns in. If there were returns in, you would write down minus sales returns, put it down and take it away to give you your total sales, but there were none. So now it's less cost of sales. So you've got your opening inventory, and your opening inventory is £120. Add on your purchases, the goods that you bought throughout the year, £1,460. Now, if there were any returns out, you would take that away. You would add those two together, put your sum in there, and then write in minus returns out and take that away. But there were none, so then it's simply into minus closing inventory. And the closing inventory, I'm putting a bracket around it because I'm taking away, is £450. So £120 plus £1,460 minus £450 gives us £1,130, and that is our cost of sales. Then you've got your sales minus your cost of sales, and that gives you your gross profit. Your profit before expenses of £27,920. So in this question there were no returns. There were no sales returns. If there were, you would write in minus sales returns, put it in and take it away. There were no purchases returns. If there were, you would have to put it in here and take it away. So we've got our sales, opening inventory plus purchases minus closing inventory gives us our cost of sales. Sales minus your cost of sales gives you your gross profit. Now you complete your less expenses. And as you go along, you should be ticking off what you have used already. Everything in your trial balance should be ticked off once, and each of your notes should be ticked off twice as you use it twice. So less expenses. The first one is your admin expenses. Okay, and your administration expenses. Now you must remember that in your administration expenses it was £175, but you have to add on your £55 which was still owing. So your administration expenses is £230. The second one is your wages that have to be paid, £5,500. The next one is your electricity. Our electricity is £750 plus, but there is £83 still owing, so our electricity is £833. The next one is our rent, and there are no accruals or prepayments, so our rent is £7,680. Our next is our advertising, and your advertising, there was a prepayment of £250. So it's £1,123 minus £250, so our advertising is £873. The next is our telephone, and our telephone is £593. The next one is our insurance, okay, and our insurance is 1,750. Now let's tick off the expenses that we have used: wages, rent, insurance, electricity plus amount owing, advertising minus prepayment, telephone plus amount still owing, administration expenses plus amount still owing. So we've ticked those off. So we've got 1, 2, 3, 4, 5, 6, 7 expenses. The next one that we have to include is our depreciation. And we have worked out our depreciation. Our depreciation of the equipment, we earlier calculated it that it was £1,700 for this year. So we have to put in that £1,700. Our next one is our allowance for trade receivables, and we have worked it out. It's £140, so we write it in. So the next thing we do is we add up our expenses, and if we add up our expenses, they come to £19,299. Take that away from our gross profit, and that gives us our net profit after all our expenses have been paid, and our net profit is £8,621. Now, that is most types of expenses in that. If there was any discounts, I'll tell you where they go. There are some other items that you need to know about that weren't in this question. If there were discounts received, you would add that on to your gross profit. Anything received is added on to your gross profit. So if there was discount received, rent received, you would write it in there and you would add it on to your gross profit. Discount allowed would go into your expenses. Other things that would go into your expenses may include carriage out, transport costs, and also bad debts. We have an allowance for bad debts here, but if there were any actual bad debts, they would go in here also. Remember, there is a difference between a bad debt and an allowance for bad debt. A bad debt is where you know that a customer will not pay. For example, the customer has left the country, the customer has closed down. So if you know that a customer will not pay, it's a bad debt. You write it off. So you would put that into your expenses. Bad debt and whatever the amount is. In this question we had an allowance for bad debt, and an allowance for a bad debt or a trade receivable is different to a bad debt, because this is where you only think that a customer may not pay. This is a provision. You are setting aside money because you think on reflection some customers will not pay. So what you do is you work it out and you put it in here like what we have done. Okay, so that is our income statement done. Now we have to do our statement of financial position. Okay, so the first thing that goes in is our non-current assets. Okay, and we only have one, which is our equipment. Now we need 3 columns for our non-current assets. The first one is called cost, the second one is called depreciation, and the third one is called written down value. The cost of the equipment is £6,299. £800. And we tick that off as we use it. However, we have depreciation, and the depreciation goes in here. Now I'm going to give you some information. Whenever you are putting in the depreciation, you may have to put in two depreciation figures. Okay? The first figure will be the depreciation for this year. And that is what you have calculated and what you've put into your expenses. For example, the depreciation for equipment here, we worked it out as £1,700 and we put it in. That's the first thing. The second depreciation that you may have to put in is any depreciation from other years, an allowance for depreciation from other years. In this question there was no allowance. If there was an allowance, it would be listed in your trial balance. It would say an allowance for depreciation and they would give it. For example, £200. But there was no depreciation from other years. There was no allowance from other years. So we don't have an allowance in this question. We just have this year's. So the depreciation that we worked out for this year is £1,700. We take that away and we get the written down value of our equipment of £5,100. Now we work out our current assets. The first current asset is our closing inventory. And our closing inventory is £450. Then we put in our trade receivables. Now our trade receivables is £700. However, we have created an allowance, so we have to take that away, minus an allowance. And the allowance that we calculated was £140, which we put into our expenses. Now earlier on I talked to you about bad debts. If there were any bad debts, you would also put those in, minus bad debts. But there are none, so 700 minus 140 gives you £560. Now you put in your prepayments. The advertising has been prepaid and you put that in as £250. Bank. Notice bank can be on either side. You need to be careful. In your trial balance, the bank can either be on the debit side or the credit side. If the bank is on the debit side, it's money in the bank, it is a current asset. If it's on the credit side, it's an overdraft, it's a current liability. But here it's on the debit side, so the bank goes in to our current assets. So the bank of £795. So we have got our current assets, we've got our closing stock, we have our trade receivables, we have our advertising prepaid and our bank. And we add those up and we get £2,055. Now we add together our non-current assets and our current assets, and that gives us our net assets. And the net assets, or the total assets in this business, is £7,155. That and that added together. Now we have got our equity and liabilities. The first thing that goes in is our opening capital. And our opening capital in this business is £6,500. Where do you get that from? You get it from the credit side of the trial balance. Okay, we've also used our trade payables. Okay, we've also put in our bank. So most things have been now used up. So we've got our opening capital of £6,500. plus our net profit. We add in our net profit. Where do we get our net profit from? We get our net profit from our income statement. And our net profit is £8,621. Minus drawings, that is money that the owners took out of the business. Where do we get our drawings from? Again, from the trial balance. It is on the debit side. The owners took out of this business £9,089. So you put it in £9,089 and make sure that you know that you take it away. So we've got our opening capital, the money that the owners put in at the start, the net profit which belongs to the owners, and then you take away the drawings. And that gives us £6,032. Then we've got our current liabilities. And that's our trade payables from our trial balance. And our trade payables in this question is £890. So we've used that. So we'll put that in, £890. Accruals, anything that has still to be paid. Remember, your current liabilities are everything that the business owes and has to be paid within the next year. So we add up our trade payables and our accruals, and that gives us £1,123. Then we put in our long-term liabilities. In here you would put in any bank loans, but in this business there were none. So you put in 0. And the final thing that goes in is our total equity and liabilities. And we add up our equity and liabilities, our current liabilities, and our long-term liabilities. We add those up, it comes to £7,155. And we know that we have completed it correctly because the net assets and the total equity and liabilities are the same. So we have done it correctly. Okay, so going back to the question, we have done the income statement, we have done the statement of financial position. The next part asks us to evaluate the merits and drawbacks of these accounts. So you need to be able to evaluate what benefits are the final accounts to a business. So evaluation means you look at the merits and you look at the drawbacks. The merits are it enables the owner stroke investor stroke manager, depends what way your question is asked. If they ask the question, what's the merits and drawbacks to the owner, you use the word owner in your answer. If they say the merits and drawbacks to a potential investor, you use investor in your answer, and so on. So the merits are that it enables the owner or investor or manager to measure profitability, to measure how profitable the business is, okay, by looking at the gross profit and the net profit. The second advantage is it enables the owner, investor or manager to investigate the expenses of the business, to see how efficient the business is in controlling its costs. The third advantage is it enables the owner or investor or manager to measure the liquidity of the business by looking at the relationship between current assets and current liabilities in the statement of financial position. Liquidity shows if the business is able to pay its way. And the fourth advantage, it enables the owner, investor or manager to measure the worth of the business, to put a value on the business. And now the drawbacks. So we look at the drawbacks of the final accounts for a business. The first drawback of the final accounts is that it's based on historic figures. Figures that are out of date. These figures here are for the past year, but we're now maybe 6 months on, so they're based on old figures that are out of date. The second drawback is that the final accounts can be manipulated to make the business look better than what it actually is. And the third drawback is the final accounts do not provide any information about any qualitative issues relating to the business. For example, the goodwill of its customers, a good location, or a good corporate image. Finally, within final accounts, you need to know your key terms. Some key terms that I've put here, for example, the difference between gross and net profit. Gross profit is your profit before expenses. Net profit is your profit after expenses. You also need to be able to explain what is sales revenue, what's the difference between opening and closing inventory, what's the difference between trade receivables and payables, what's depreciation, why is it important, what's the difference between prepayments and accruals. You need to go through your book and make sure that you know all your key terms.